Hello.
Morning, Myron. How are you?
I'm good, Jamie. Can you hear me?
I can hear you just fine.
Well, then life is
Good,
good. I'm
good.
now I can relax. I'm I'm hooked up.
Well, that's just it. You're the first one, so yeah, you're ready to go.
I'm ready to go. Yep, bring 'em
All
on.
right.
I'm on hold then.
Yep. We'll get started. I guess, yeah, you got a half hour. Sit back and have a cup of coffee.
Oh, I thought it was supposed to be at 8:30 we were starting.
Well, we get the video and everything going at
Oh,
8:30, so
okay.
we're all
Yeah,
ready and on by 9. So
Jamie, I just looked at the agenda. It says 9 a.m.
it does,
But
yep.
it's better to be a half hour early than a half hour late.
Yes.
All right,
So,
I'm going to sit back and drink my coffee, and I'm
yes,
here.
please do.
Thank you. Have a great day. Okay.
Good morning, everybody.
Good morning.
We'll be starting at 9 o'clock, so thanks for jumping on early. We're getting everything kind of set up here on our end, but we'll still have our start at 9 o'clock. Just wanted to let you guys know if there's some silence yet for a little bit.
We like silence.
We aim to please, Myron. We aim to please.
Thank you. Thank you.
All right, we'll call the meeting to order, and I think I'll have you call the roll to start with.
Apple,
Here.
Brunken,
Here.
Clark, Liza,
Here.
Gronland,
Here.
Gruis,
Here.
Heineck,
Here.
Johnson,
Here.
Leonards,
Here.
Oakland,
Here.
Prim,
Here.
Roth,
Here.
Salter,
Here.
Seeley,
Here.
Schroeder,
Here.
Terwilliger, Cheddar,
Here.
Clark, Matt.
Here.
We have a quorum. All right, we will call the, we've called the meeting to order. Basically, your April Fool's joke was that we're gonna have an in-person meeting, and the weather had other ideas. A few announcements to start with. We were all emailed our materials, and actual potential motions were in those materials. And I would ask that if you make the motion, that you state your name and actually read into the record what the motion will be. Otherwise, we would ask that you, at least the board members, keep their cameras on so we can see that you're actually here, but be mindful that other people might be able to see what you're doing back there. Also, if you would use the raise hand function if you want to speak, it kind of pops you up to the top of the screen, so we will be able to see that you're wanting to speak. Item number 8, Travis and I had this discussion yesterday. It's a item that we really want to have some board interaction on with the long-term goals, and it's really difficult at times to do that online. So we decided to move that item to the June meeting when we can actually see each other face to face and hopefully have some good discussions, because we want to have a couple hour probably discussion on those long-term goals. So otherwise, the agenda will be as stated, except we're going to skip over item 8, which will shorten the meeting quite a bit. We hopefully be done around noon or lunchtime. So, do we don't need a motion to the agenda. Okay. Any other remarks before we get started?
No, just as long as the rest of the board is okay with deferring item 8 to June.
Okay.
If everybody's okay with that.
If somebody had a issue with that, please raise your hand and speak. Otherwise, we will consider the agenda as is without item 8. And it's possible we may be taking things out of order if at time needs to be, but otherwise we will move on to the board conflict disclosure. This is the time for the board to discuss any potential conflicts of interest. No written requests for a waiver were received prior to the meeting. Does anyone wish to disclose a conflict and request a waiver now? If there are no disclosures, we will consider this item complete. And I don't see any. I would look for a motion to approve the minutes. Everybody got those sent to them in their package?
Moves to approve the minutes of the SDRS Board of Trustees December 10th, 2025 meeting.
All right, I have a
Wes
motion.
Cheddar here. Second.
Wes Cheddar seconds that. Any discussion on that motion? All right, seeing none, all those in favor, please indicate by saying aye.
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 Those opposed, please say aye or nay. I hearing none, that motion is carried. All right, let's move on to public comment. Public comment is a regular item on each agenda that allows the public to discuss topics not listed on the agenda or items on the agenda that do not require board action. Additionally, the board will accept public testimony on any item that requires board action. Anyone wishing to address the board must indicate their intent by signing in on the provided sheet by the door. Speakers are limited to a maximum of 3 minutes, and all remarks should be directed to the Board of Trustees. Individuals may also submit written remarks, whether or not they speak before the board. For more information, please refer to the policy for public comment and public testimony, which is located next to the sign-in sheet. And we had nobody sign up, and I don't see anybody that wants to speak. So we will consider that item closed. Item number 5 is an update on the board member election. I'll turn it over to Jamie for that.
Okay, there's one board position up for election this year, which is the teacher position currently held by Penny. We received 2 petitions, which results in a contested race and an election. So this year ballots for the election will be mailed by the end of April. They must be returned to our election administrator by May 26th, and the results will be certified at our June board meeting.
Is any questions about that? It's so basically one election this year. All right. All right, let's move on to item number 6, which is the investment performance update. And I see Darcy and Danielle will be giving most of this, and maybe Matt will chime in, but go ahead.
I think Jared and Jan will also be
Oh, yeah.
joining Darcy and Danielle. And
Oh, I see
they're
that.
just going to give us some good information here. So we'll turn it to Darcy. I'm assuming Darcy's starting, so.
Yeah, I will start. Thank you. Good morning, everybody. Nice to see you all on the Hollywood Squares for a different type of meeting this morning. But for the return through the close of yesterday, we estimate that the SDRS would be up around 6.25%. Factoring in our best estimates for the partnerships and how they may have performed through the first quarter, we would estimate the return would be around 6 to 6.5%.
So we are still conservatively positioned as we have been for quite a while, a little bit below 50% equity-like risk. We are targeting our minimum in stock-like assets, including those that have a stock-like element such as partnerships and high yield. And as a reminder, the benchmark for this equity-like risk is 70%. The estimated total asset value of STRS as of March 31st is $15.8 billion. I also wanted to provide for you a couple really quick comments about how our internal asset classes have performed. So I'll start with high yield. As you probably heard or seen, similarly to equities, our internal high yield for the fiscal year to date is outperforming its benchmark. The high yield team believes that high yield has been expensive as credit spreads have generally been tight for quite a while. And thus we've been relatively conservatively positioned outside of a couple of post-bankruptcy equities. This fiscal year to date, the largest of those equities has done pretty well, and this has helped our internal return. Typically, credit spreads are what drives the high yield return, but this month the Treasury market has had a bit more of an impact than is normal for us. And credit spreads have widened a little bit, but generally remain tighter than what the long-term historic average has been. However, there's been some widening for specific names and industries. The high yield team generally has been conservatively positioned from both an industry perspective and duration or the maturity of the bonds. In aggregate, we generally own shorter maturities than the benchmark, which has helped drive our positive relative return. With that, I'll pass it over to equities.
Good morning, I'm Jan Zeek, and so for global equities, so far fiscal year to date performance is running ahead of relative performance is ahead of the benchmark. It moves around quite a bit and it's changing every day, but current relative returns are positive by about 400 basis points. This is an improvement from the December meeting when they were just a little bit positive. And there are a couple of sectors that stand out that have helped. The first is energy, and that's an area that's lagged previously, although it's been a positive contributor for most of this fiscal year. But even more so recently, as oil prices have gone up due to the conflict in the Middle East, we've been using recent strength there to trim positions, but we still do have exposure. And then technology, some of those larger names that are more exposed to the AI theme have pulled back, and so that's helped some. We've also benefited from having exposure to some of the memory and semiconductor capital equipment names that have performed really well recently. And lastly, we have had less exposure to kind of some of the software names that have underperformed due to concerns of being displaced due to artificial intelligence. That concludes my prepared remarks. I'll turn it to Jared.
Great.
I'm Jared Edlin. I'm going to talk a little bit about the small mid-cap side. So since the last meeting, the small mid-cap strategy is up about 6.5 or 6.3% on the benchmark. That's an improvement from about 3% outperformance from the benchmark. There's been a lot of volatility in the small mid-cap side. As markets go up and down, our stocks swing a lot more. And contrary to the Mag 7 performance, a lot of small cap tech names have begun to participate in the significant upside that is the AI trade. And that's been a big drag on our performance. There's been a few of the largest names are up about 300% this calendar year. And that's a move we don't typically see in stocks in such a short period of time. We've got a large exposure to energy, and that's been a huge win since the Iran war. The last 45 days has been nice performance from that. We've generally also trimmed some of our positions, although we still think that the prices don't reflect the normal long-term price that we expect. And there may be some increased risk premium that enters the market for some period of time, which could also benefit that space. Another significant area of outperformance came from the consumer space. A lot of consumer restaurant names, consumer durables like housing have really suffered in the last 3 months, and we've been underweight that area fairly significantly. Another area that's been a point of outperformance was in the financials. Our positioning within financials, while we're overweight, has been beneficial to the performance of the small mid-cap side. With that, I'll take any questions that anybody has.
I kind of had a couple of questions, and you touched on us, and we're kind of overweight in energy. Of course, there's been quite a run up with the war and the energy prices. It says, and you touched on it a little bit. Is some of that maybe going to come back down as energy prices come down, or do we rebalance any of that?
Oh, for the energy outperformance, you mean? Do we?
Yeah.
Yeah, so that's, as I mentioned, that's kind of what we've been doing. Jared, I think they're maybe taking a little bit of a slower approach in SMID because maybe what they're seeing, I'll let him say for his companies, but what we're seeing for our companies is there are a number of them where the valuations are reflecting a much higher oil price. Our normal oil price wasn't, the $60 that we were seeing prior to the conflict, and it's not the $120 peak we've most recently seen anyway. So the current conflict allows the value of those companies to be realized in a quicker fashion. They may not quite be to fair value, but just like with asset allocation, we tend to scale in and out of things based on the magnitude of the relative cheapness. So we want to be paid for the risks that we're taking. And when we feel like, we're being paid, but not as good as we were, then we might not want to have as large of a position as we once did. So we are constantly rebalancing that and looking for something else that might be attractive to take those funds and put it into.
Yeah, I think that's a great question. It speaks to the way we try to manage our assets internally, both from a total fund and individual portfolios, in that we're trying to move into stocks that people aren't necessarily excited about when we think they're trading below their intrinsic value. And that led us to our positioning in energy most recently. And what's occurred in the last kind of 3 months is somewhat a reflection of increased global risk premium, but also after this war started, there's been significant changes to the long term for some parts of the industry. And I think that's more exposed on the large cap side. I'm going to talk about LNG, for instance. Plant was hit with a missile that's going to cause significant damage to the largest LNG exporting facility in the world. And that's not just going to be fixed tomorrow. Jet fuel, if you had to buy it on a per barrel basis, is over $200 on the seaborne market. That's almost a 3x increase in the price of jet fuel. So anybody that makes that stuff globally, LNG or refined products, has seen a significant benefit. While the price of crude oil in the United States is about $20 less than the global price. So some of our small mid-cap names haven't had that same increase, although they've had a nice increase. It still doesn't fully reflect what we think is even a long-term normal, regardless of what's happening right now.
But I noticed in the market, there's been some winners with the war and other ones have really taken a hit. I suppose we're always looking at if there's values in certain areas or stocks. I assume that's what you guys do too. Yeah, and then we always talk about there's these, like right now, we're pretty much at minimum stocks. And as with the stock prices going down, have we even come close to hitting any of those targets or trips to increase some of that? Or are we quite a ways away from there yet?
Yeah, so as you know, we are continually monitoring every day during the day when we hit the rebalance points or any of our other triggers. We have not hit an equity trigger yet, even though markets are down from their highs. We continue to believe that markets are overvalued, and however, they are less overvalued now than they were before. To talk a little more specifically about it, our equity trigger is currently a little ways below the low of the market that you saw last April. However, we were further away from the trigger then because as time passes and companies make more money, have more cash flow, our fair value, because of those accreted earnings, does increase over time. So our fair value has grown. And so we are, as time passes, and if earnings stay strong, we are getting a little bit closer to that value, but we're still today pretty significant ways away.
If I could just add something to that, so we have lower equity exposure. We're looking to buy low and sell high, and that often causes us to be really early in our process. What we're really most worried about is missing the opportunity to get out before we have a really large crash. So it's undesirable to be early, but it's acceptable because we're looking to avoid those really large drawdowns that would be impactful to the fund. And we know we need to be really patient while we wait.
If anybody else has questions, please raise your hand or let me know and I'll open it up. Because I don't have too many more questions. So Matt wants to speak. Go ahead, Matt.
Yes, thanks. I just wanted to ask the team if they could talk about how, even though we haven't hit any big triggers, to change our risk position, to talk about whether we've hit any rebalancing thresholds, that have caused, smaller adjustments to our equity positions, in the last year.
Yeah, I could take that. We have hit other rebalance triggers with the market continuing to increase over the past year. We're monitoring our ranges intra-month and even daily if we perceive that we're getting close. And so we've had to pare back and sell equities or, adjust our asset allocation so that we kind of stay within our ranges because we have a kind of a 1% drift on the downside as far as we can't go 1% below our minimum, but then we have a 2% drift on the upside. So we constantly monitor that to make sure that we're just not kind of letting the portfolio, float to wherever the market takes it. We try to keep it within our targets as closely as we can.
One question I had, of course, with higher energy prices and the war, it has to be inflationary pressure on the economy. How much effect's that going to have on interest rates and equities and basically our whole outlook on what's going to happen here?
I think the interesting dynamic in our economy today versus if you go back to 2008, when oil hit, close to 150, the GDP of our country has expanded significantly since that point, maybe up, 2.5 times. But oil prices are significantly below that point. So the energy intensity of our GDP dollars has gone down significantly. So while I think it is an increase and it will burden some industries more than others, especially if the consumer was already tight and job creation isn't strong. It's not near the impact that it was in the past. And certainly if you go back to the 70s and that oil crisis, the energy intensity of the economy was significantly more than it is today. So I think the burden won't be quite as hard or as high. And if you remember back in 2022, oil was $120 a barrel. So it's not unprecedented territory today. Now, if that changed and it rose significantly from here, I think the pressure in the economy would increase significantly.
I would add from more of a bond market perspective and the bond part of the asset allocation model, inflation and our long-term view of inflation relative to current inflation impacts both our equity discount rate, but also what we think the fair value of bonds is. And so that's another thing that we've been monitoring from the asset allocation side is what we think interest rates both should be, but also where bonds have moved. And so if you've seen the interest rates on the long bonds have actually increased. And so that is starting to make bonds perhaps look relatively closer to fair value or less expensive than they had been before. We still are at our minimum bond-like risk, but we're getting, just like equities, it's moving towards where we think there could actually be something interesting for us to potentially decrease our underweight in.
Do you think there'll be more borrowing? I would think that our federal government's spending money, quite a bit of money on this whole conflict that might pressure them to borrow even more money. That would, I assume, affect all those interest rates and bonds. I haven't seen anybody raise their hand yet for another question, so.
Yeah,
Yes,
definitely would be true.
Yeah, anybody else want to ask anything? It's an interesting market. It's like it kind of gave updates for the meeting and it changed about every hour because you don't know 1 hour it's up, next hour it's down. It's crazy. I'm sure it makes for interesting work every day watching that and figuring out what's going to happen. But all right, so if there are no other questions, then I guess we would consider this item closed.
Yeah.
All right, thank you guys.
Thank you.
Thank you.
Thank you.
Item number 7 is the projected funded status as of June 30, 2026. And Doug's got a presentation for us on that. And I'll be turning it over to you, I guess.
Thank you, Mr. Chair, and good morning, everybody. This is going to pop up here in a second. Our regular quarterly update of where we might be at the end of the fiscal year with our funded ratio, our funded status, and also the contribution, which would determine the COLA that we would pay at July of 2027. We're not there yet, are we? It's like flashbacks to the pandemic and all the virtual meetings we had.
It's just very slow.
It's cold out.
It doesn't want to work either.
I think I have control too. Okay, here we go. So we like to always start with the basics. And at the top of this page is all the actuarial work we do boils down to that one simple equation, that contributions plus investment return will equal benefits and expenses for every type of pension plan, every type of retirement plan, right? What we pay out of the trust, which are benefits and expenses, has to get in there first, and they'll get in there one of two ways: contributions and investment return, right? So most pension plans have the B, the benefits, fixed, and that C, the employer contribution, varies each year. And we'll show you how that's worked out for a lot of the plans around the country here in a couple slides. Since 1974, we've had the contributions fixed. The C in that equation is fixed. And we've been charged with managing this plan so it stays on a sustainable track with those fixed contributions. So the main tool we use to do that is the COLA. And we're going to talk a little bit about how that came about, when that came about. Our current COLA structure is that when we can afford the full COLA range, we'll pay up to 3.5%. We'll pay inflation up to 3.5%. When we can't, we reduce that range, the top end of that range, to what we can pay, and we stay with keep a funded ratio of 100%. Which means our assets are equal to our liability schedule, how much we should have in the trust with the continuing contributions to be able to afford these benefits. Right. We also have our statutory funding thresholds that are in SDCL 312C228 that say if we can't stay 100% funded, if we take that COLA all the way to zero and we drop below 100%, or our contributions aren't covering the cost of the benefits that are being accrued, then we have to the board is required to make a recommendation for corrective action. The COLA variability started in 2010, refined in 2017, and again in 2021. It's a really powerful tool. Back before we had the variable COLA, about 25% of the cost of the whole plan was wrapped up in that COLA. So it's a logical place to make these adjustments so that we stay on that sustainable funding track. Did the first time, I think. There we go. So we've got two charts here that show how our process, the fixed contributions, is played out compared to how most state plans work with fixed benefits and variable contributions. And let's start on the right-hand side, right? We have fixed member and employer contributions. We're charting the employer contributions here for SDRS from 1974 until through the 2002 fiscal year. Our Class A, our general members, were paying 5% of pay into SDRS. Their employers were also paying 5% of pay. 2002, July of 2002, that increased to 6%. We've been there since. Our goal here is to manage the plan on those contributions, on those fixed contributions. The red line is your median state plans, and we're comparing like to like. So we're looking at the employer contribution for general members and teachers, meaning not public safety, not judicial members, and for plans that are in Social Security, whose members are also in Social Security. Because if you're not in Social Security, you have higher contributions and higher benefits. So since 2002, when plans were about where we are, the median contribution now from those employers are 15.5%. So the employers for all those plans are paying 2.5 times what SDRS participating employers are paying into the trust. I want to look at a couple of points on the left-hand chart here. That's the funded status, the assets compared to the liabilities for SDRS and for your median state plan. And a couple of points there that I want to look at. 2007, we were 131% funded, 126% after a benefit improvement that was enacted at that point that brought the multiplier for all service before 2008 to 1.7% for our Class A members. Public safety went from 2% to 2.4% for all service before 2008 there. 2 years later, with the financial crisis, we dropped to 76% funded. First off, a 50% drop. And we were, if I'm recalling, we were with a few people here that were in the room at the time, we were somewhat conservatively invested at that time because conditions were similar. And I remember Mr. Clark's warnings about where the investment markets were at the time. So we were short of our statutory funding thresholds that we mentioned a minute ago, and the board was required to make a recommendation for corrective action. We had just implemented that benefit improvement, and in that legislation was a clause that said, hey, if the financial conditions reverse, we can undo that benefit improvement. We could take that benefit improvement away. Well, the board made the decision at that point not to do that, not to enact a cut in benefits, but to instead modify that COLA from something that was a fixed 3.1%. That's not where we started at SDRS. That's where it had migrated to with a lot of benefit improvements. But to make that variable. And in 2010, the first version of our variable COLA, it varied between 2.1% and 3.1% based on the funded status. It didn't take us too long to realize that there wasn't enough variability in there, that that change was not big enough to handle the economic conditions that were coming. In 2017, we were making another significant change, and that was reducing our expected investment return from essentially 7.5% down to 6.5%. When you drop that investment return assumption by 1%, like we were doing, your liabilities go up about 15%, ballpark, right? So we were going to be below our statutory funding thresholds, again, because of that change. Now, if we look back at about 10 years since that time, our annualized return has been about 6.51%, which is what our assumption was. So if we look back, for the last decade, we got that pretty darn good, right? We were pretty correct on that. But we also needed to make another change, and the change was to add more variability into that COLA to allow us to go from 0.5% to the 3.5% based on inflation. We didn't want to keep paying COLAs in excess of inflation. We knew we couldn't afford to do that. So that's where that change was enacted as well. So that's just a little history about how we got to where we are right now with the COLA, which we'll look at in a minute. This chart on the spending, the government spending on pensions, this is a new version of this. That was the report was released later in the day after we sent the first version of this presentation out. It looks very similar to last version. It's based on census data. So 2023 is the most recently available. In South Dakota, we spend 1.75% of all government spending goes towards pensions, right? That's down a little bit from the last version of this. The median across the country is just about 4%, right? That's gone up a little bit. The average is over 5% when you weigh in those states at the far right in this chart that are making a lot of contributions to try and close a funding gap, to try and solve a funding problem. So we are spending in South Dakota the lowest in the nation on pensions, and about 1/3 of the average across the country of what states are spending on pensions. Which leads us to, we like to remind you the competing objectives. We have long-term benefit goals that we were going to talk about today. We'll bring that back in June because we do want a lot of interaction on that. But the two charts at the bottom kind of point to the conflict between staying on a sustainable funding track on these fixed contributions and paying adequate and appropriate benefits. If I focus on the change between the middle set of columns on the bottom left, where we were in 2002, and the right hand where we are now, this is the expected life expectancy for retirees that are age 65. Right. So in 2002, if we look at the females, which are the red bars, right, from 2002, we've added 2.1 years. So we're expecting to pay female retirees 10% longer than we were in 2002. On the right hand side, on the blue bars, the males, we're expecting to pay males 3.7 years longer than we did in 2002. That's a 20% increase. So if we're expecting to pay benefits somewhere between 10 and 20% longer, our costs have gone up because we are recognizing that expected payment stream is a longer stream of payments to our members. On the right-hand side, we're looking backwards 20 years for what we assumed for investment return in the red bars and in the red dots, and what the actual return was. And you can see in those early years of SDRS, we had a lot of excess investment return over our assumption. 12 benefit improvements were made to the benefits, including that COLA about 5 times was improved. And then in recent years, we're still, if we look back 20 years, we're still above our assumption, but just barely, meaning there's not a lot of extra money to spend there.
Question from Jim Apple. You have a question, Jim?
Yeah, I'd just like to make a point here. I think that has to be with that increase in age for people, if you look at the last 24 years, we've gone up 5.8 years in, giving out benefits, which I'm all for, but that has to be a talking point to, I think, a lot of the retirees and people in this, because, about a month ago, I was approached by a gentleman who was, he goes, geez, we're only getting a 1.5 something % raise, on the cost of living and this and that. And he was going on, and I go, well, I said, does your wife have a pension? And he goes, well, yeah. I said, did she get a raise this year? He goes, well, no, hers is fixed. She's never got a raise. And I said, so I guess when we get something from here, it's not going to equal inflation, but, we're trying at least. But I think this has to be another talking point that, with people are living, if you take a look at that, if we got for males and females, that's a 15% more payments we're paying out on average, 5.8 years. That's got to be another talking point, I think, for people to be aware why, hey, I'd love to give out 3% raises or whatever it is, for people. But when you're adding all those more benefits on, and I believe yesterday we were talking and, we're paying out, $800 million. And with this keep going up and up and up, it's going to be more and more and more, it's going to be difficult to, hit and match inflation and all that. And I think this really needs to be a talking point because, if we've added almost 6 years on in, 22 years or 24 years, in 20 some more years, it's going to be the same thing. We're going to add another, with people being healthier and everything, we're going to add more of that on, which is going to really affect our COLAs moving forward, So, I'm glad people are living longer, but this is, I think, a talking point. And then after the funny point was after I got done talking to him and I explained, and he talked about his wife, not getting a pension, a raise in her pension ever, in the last 15 years. Then he turned to me and goes, well, you know what the really good thing is? And I said, well, what? And he goes, I'm making way more money than I ever did, and I've already taken more money out than I've ever put in. So he was pleased and happy with that. But, everyone, with the cost of living going up and inflation, they're all worried about that. But in the end, he was still happy with, he's already taken more money out, which is the key thing there. And he's going to be taking it out. He's still rather healthy for another 15, 20 years, I'm assuming. So anyhow, I just think that needs to be a bigger talking point looking at it, especially moving ahead.
I think you bring up a good point. There's a lot of competing items that have to be balanced here to keep this system in balance. It's not just inflationary increases, it's also wage inflation, it's longevity, and all these things have to be balanced. And it's very delicate balance too, because at some point, if longevity gets to be too long or wage inflation gets paid for a little bit up front because we have more contributions, but some of the longevity stuff, if you're living too long, then you can't have as big a benefit to start with. We've kind of set the system up to have a good initial payment so that they have the money when they really want it when they're younger too. And then have the inflation built in also so that you're not outliving inflationary, that the inflation is not going to get you in the end either. So we're trying to balance all these different things. So Jim brings up a lot of good points there. We do need to talk about when people say, well, you're not keeping up with inflation. Well, we also provide all these other things that we have to keep up with too. So.
And there's a couple things I wanted to respond to there. If we look at the average increase, right? If we kind of blend that 2 years for females and almost 4 years for males, we're about a three year, on average, we're probably paying benefits about 3 years longer. That changed from 2002 to 2026. The next 20 years, we are not expecting the same rate of increase. We made a big change on the actuarial front to move towards, we're already incorporating in an estimate of what the future improvement's going to go. Now, we don't know exactly how that's going to play out, so there will be some adjustments, but we've taken the big hit on the mortality to make that systematic change to do future improvements as well, and taking that into account. The other thing is that comes to mind, and I'm gonna slide to the next page here as we go. We've made a lot of steps to try and tighten our belts. We kind of saw this coming. It started in 2004 with the service purchase changes. 2010, we made a lot of those changes to the COLA, the initial COLA, and the retire rehire reform. Again with the COLA in 2017, and the three changes on the right there that go into the 5-year final average, the pay increase, the spiking caps, and the generational design were all in 2017. As we were knowing, we were going into a crunch when we were recognizing that our future investment returns were likely going to be a lot lower than we had previously anticipated. The generational design incorporated a 2-year increase in our normal retirement age. So we were recognizing we're still on that same budget coming in, but if we're going to pay out benefits 3 years longer, we've got to make some adjustment for that, and start the benefits or start those full benefits a little bit later as well. So that was one of the features we were trying to do there. This pressure isn't going to get any easier. We don't see any easing of this. We are going to have to balance our benefits with the money we have, the resources we have on hand, and those are based on fixed contributions. If we walk through, and I'm going to take maybe another minute more than I usually do on this, our COLA calculation for July 2026, it's a 2-step process. The first one is we say, okay, if we were going to pay the full COLA range, well, we've done some work on that, and we expect our COLAs to average 2.25% if we're going to pay from 0 to 3.5, with some modeling of how inflation bounces around on that. Okay, so if we pay that COLA for the lifetimes of all of our members, we get a liability number, how much we should have in the trust if we're going to be on schedule to pay that. We compare our assets to that number and do a ratio. If that ratio is 100%, then we're done. We go down the left-hand side of this chart. We pay 0 to 3.5%, wherever inflation falls in there. It was less than 100 this year, so we say, okay, we'll step down the top end of that COLA. At what point do we get to where the liabilities are less than our assets? I said that backwards. That ratio of assets to liabilities is 100% or more. And that happened at 1.56% this year. So our COLA range then becomes 0 to 1.56. Inflation for the year was 2.76. So we will pay the 1.56 coming this July. If we look at where that COLA range has been, which is the height of the green bars on this page, since we've been on the current COLA process in 2017, that move was 2017 legislation. We started out with a 0.5% minimum, which is why that's the first 4 green bars are off the axis. And then you can see the top end of that started at 1.89 and then moved around a bit the first 4 years. The black dots on that page are where inflation came in. So the first 4 years, we were feeling pretty good about that. We were able to match or stay pretty close to inflation. When we look then 2022 COLA, that minimum went to 0. And for that first time in 2022, we were able to pay up to 3.5%. We did, in fact, pay that 3.5% COLA in 2022, but inflation spiked up to almost 6%, then almost 9% the following year, and still over 3% the year after that. So a lot of our gap between the COLA and inflation, if we look at people cumulatively and where they are compared to inflation, a lot of that gap happened in those 3 years, right? Where we can't, there's no way on 6% contributions we can afford to pay a 9% COLA when our return was pretty low that year as well. Yeah. So we're going to look forward now towards the end of this fiscal year, and then we're going to take a little bit longer. we've said that the investment risk is usually the most meaningful, most impactful change. The couple of years, maybe the 3 years before this, prior to this fiscal year, we've had salary losses. And a couple of those were significant when we had the 6% salary increase and then the 7% inflationary increase. We took some significant increases in our liability. We call those liability losses. Liabilities were higher than we expected because of that. But this year coming up, we're expecting a salary gain. If we had to ballpark it, maybe 90 million. We'll know for sure once we get all the data in after the end of the fiscal year and we actually do our calculations. So we're going to have some upward pressure on this because of the salaries. We are going to look at 1 year projections and 5 years and try and put some likelihoods on that. We do rely on some work by the investment council staff for investment portfolio statistics that we bring in there. Yeah. So the left-hand column here on slide 9 is our independent variable. So if investment return is what's in that column, then we do our step 1. We call that our baseline fair value funded ratio. And really what we're looking at there is, are we above or below 100%? And then that determines our COLA range. And then the final number is what we report in our financial statements when we assume the COLA, the maximum COLA there that we determine. Across the page, the red line, the first one, it says if our returns for the year are less than about negative 7.6%, then we are unable to afford any COLA, and we fall short of the statutory funding thresholds, and the board's required to make a recommendation for corrective actions. That middle, the middle green line there, at about 13.5%, we'll be able to afford the full COLA range. And the intervening lines are to give us some idea of where we might be this year. So you heard from the investment staff 6 to 6.5% on where we might be so far through this fiscal year, with a quarter of the year left to go in pretty volatile markets. See yesterday and the 2 days before that as reference. We might add 0.5% to their estimate based on those salary gains that we're expecting this year. So 6.5 is a pretty good shot at a best estimate of where we're at right now, which would keep our COLA roughly the same as it was for 2026, maybe just tick up just a little bit if we had to take a guess today with everything we know. But as we said, quarter of the year left to go, and lots of changes in the investment markets that I'm expecting from day to day here as well. If we look at where inflation's going, this is chart, and the black line is the index that we use, the CPIW index, and the red bars is the third calendar quarter average. So really we're interested in how that red bar moves from 1 year to the next. You do see the gap on this page. There is at least 1 month that was not released by the BLS because of funding gap in the funding the government, our Congress at work. But right now, if we look at where the most recently released number was, which was for February 2026, that was up 0.7 or 0.68% from where our third calendar quarter average from last year, where our base for this next year is. That projects out, if we're halfway through the year, to about 1.4, but it's going to be higher than that. We're going to have this next month, there's going to be a big bump up. I think some of the projections are in the neighborhood of 3 that we're saying high 2s or 3. We're not seeing it yet in the CPIW. We probably will start seeing that next month as that number comes out in the middle of April. So if we take that chart that was 2 pages ago and we look at those lines across the page, and here we're trying to chart the likelihood of falling into those ranges. So we're going back to the beginning of the year. We're ignoring the investment returns to date, right? And we had the minus 7.7 would cause us to fall into corrective action territory and no COLA. we saw the likelihood of that of 12%, likelihood of having a restricted maximum COLA of about 2/3, and then about a 22% likelihood we'd be able to pay the full COLA range. That's a 1-year look from the beginning of this year, and we like to track where those red areas have been, the likelihood of having to make corrective actions. And we had crept up to about 24% in fiscal year 21. That drop from the 24 to the 14 was moving that minimum COLA from 0.5% to 0% through legislation that the board recommended and the legislature enacted. And then since that time, we've been creeping up, and that likelihood about 12% in the beginning of the year. Now, we don't want to just focus on the 1 year, and the reason for that is, 88, 90% likelihood of success sounds pretty good. If we think about that, my human nature is, well, we're fine then. If we look out 5 years and we accumulate those likelihoods, 32% likelihood we're going to have to make a change, have to make a recommendation for corrective action over those 5 years. So again, we want to point to reviewing those long-term benefit goals, keeping our contingency plan up to date, because there's a real likelihood we might have to intervene here and make changes to our benefits to keep that equation on a sustainable funding path as well. And then just wrapping up, we look like our goalposts this year as far as not having to make those corrective action changes need to beat about -7.5%, -7.5%. If we would reach that 13.5%, we'd be able to afford the full COLA range. And again, just to go back to where we started, all of this is how we're trying to manage this plan on a sustainable basis on those fixed contributions. If we get behind in our funding and we can't increase contributions, we have no way to catch up. So we're doing what we think is prudent and to manage this plan on a sustainable basis. With that, Mr. Chair, I'm happy to take any other questions that might have come up.
Anybody have questions? Either raise your hand or speak up. I was just thinking when you're doing the inflation and say the inflation came in for the year less than what we could afford, we do the lower of the CPI, and we don't look back at all like to make up for what other years that we didn't make it. It's actually either the CPI or what we can afford by your calculations.
The way the statute reads right now, yes, we would pay inflation within the affordable range. So if it comes in less, if inflation does come in less than we can afford, we would pay the lower of those two numbers.
But some things, maybe Social Security does that kind of have to look back, like if it was years that, well, they always pay it, but I mean, I've seen some systems where they kind of look back if they hit their maximum and then there was extra they could pay. We don't do that though. It's just either the CPI or what we can afford for the year.
It's worth having that discussion at some point.
It is.
Right? If we say we were able to afford the 3.5% range, which would take some good investment years, and inflation comes in at 1.5%, and all of our members or most of our members are behind inflation, that's maybe worth a discussion.
But the way it is right now, we wouldn't do that.
We would not.
We would pay the 1.5%.
We wouldn't pay in excess of inflation, and we won't pay in excess of what we can afford. So we are paying the lower of those two amounts. That's correct.
And that's something. Go ahead.
Sorry, this is Liza. That would take a statute change, correct?
Absolutely.
Okay.
Yes. But it's something to think about between here and June as we talk about a long-term goals, as maybe somebody want to discuss, because currently we don't have any really means to try to catch up for years that we don't. Even if we had good years, we would still be paying that. So with the discussion.
Yeah, and we do. I think if we look back through history, we would not, that would probably be considered a benefit improvement that this board has not recommended unless we were over 120% funded.
It would add a cost to the actuarial assumptions, I would assume, because.
Yeah, I would guess that, when we can afford that full COLA range, we model that at 2.25. If we're going to pay something above inflation up to the top of that, we'd probably raise the bar on that.
Yes,
then,
and that
right?
would be a cost associated with that,
Correct.
which would affect your funding status. So
Yep.
that's the balancing there. Other questions? Not hearing too many. No, it's a good thing. And as we think forward to our June meeting, when we talk about benefit goals, those are things we should really throw out there for people to discuss to see if we want to do something like that or how we might address. Because when we talk about we're behind inflation over the last so many years, we used to be ahead of it when we had the old formulas. We were way ahead of inflation. Well, now for the last few years, a little bit behind, and there's no way to ever catch up on that the way we have it modeled right now. And maybe we don't want to go there. Maybe it's too expensive to go there, but I guess it's worth a discussion. And that's kind of discussions we should have when we do our benefit goals discussion, and not only just in this, but in other areas.
Well, if I could jump in, that's, there's probably two parts to that, because we not only have our long-term benefits goals presentation coming up in June, but it would also be a part of that contingency plan discussion. And if we felt like we wanted to take a look at our contingency plan again and look at how we would respond to those good times or when we're in those sort of positions, that would be a great opportunity to look at that document as well.
That's true. That's true. I guess I don't hear any more questions, so thank you, Doug. Should we move on to the next item or
Yes.
All right. Well, we're skipping over item number 8, and like we said, be thinking about things we can take a look at that long-term goals document and be ready to discuss that in June. Let's move on to item number 9, which is the overview of governance manual that Jackie Storm's been working on. And want to introduce this?
Well, maybe just a couple of comments, and I'm pretty good about stealing thunder, but I'm going to try, Jackie, not to do this. But this has been a long project. I think a heavier lift than most of us ever imagined it would be when you consider all of the moving parts, when you're consolidating those into kind of that central repository that's easier for the board to manage, staff to manage, and it's just a lot of work. Of course, Paul Schrader, he's started this project and unfortunately, due to health complications, was unable to finish. And so we've turned it over to Jackie, and she's doing a wonderful job with it. But it is a heavy lift. I know Jackie and Doug and I have had a lot of conversations on this. So we just wanted to give you guys an idea of where we're at, that, it's back on our radar again. And she's going to lay out a little bit of a calendar as well as kind of agenda of how we plan to approach this. So I hope I didn't take too much of what you're going to say, Jackie. I'm going to turn it to you.
No, that's just fine. I don't care if you steal my thunder. As Travis said, this project did originate with Paul, and even though he wasn't able to complete the project, we recognize that this consolidated resource for defining the board's duties, responsibilities, goals, policies, and procedures would be of significant value for both the board and the staff. And I got the slide changed. So the purpose of the governance manual really is to provide this central repository and be a reliable resource for the board. We anticipate it will support board orientation by helping new trustees understand their duties and responsibilities, but it will also serve to you current members, trustees of the board, as you carry out your responsibilities, serving as a reference point. The South Dakota Board of Trustees, South Dakota Retirement System Board of Trustees has always demonstrated a strong commitment to excellence in government. Over the years, the board has established key policies and positions. And so having this single organized repository for these materials will make them easier to access and apply. The governance manual outlines the framework that guides your fiduciary responsibility, talks about transparency and effective oversight of the system. It brings together the governing law, including the plan document, applicable state and federal requirements, board-adopted policies, and standards of professional conduct that are expected of both the board and the staff. As Travis indicated, I want to talk a little bit about the timeline. Today, I'm going to provide an overview of the primary components of the project. These include legal authority established by statute, the goals, policies, and practices the board has adopted over time, and the board's fiduciary duties and those activities that are undertaken to fulfill them. We will continue working with the chair to develop some additional policies for your consideration in June, based on some recommendations that Paul had and practices used by other systems as well. Our goal is to have this project substantially completed by September, incorporating both the material already adopted that I'm reviewing today and any additions that you may approve in June. However, if the board has any requests or changes, final action could be in December. So we hold that out there as well. It's important to note that while there will be this inaugural version, the governance manual will remain a living document. Updates will be required as laws evolve and as the board revises its policies, practices, and procedures. The final product is intended to be this comprehensive electronic document with embedded links for seamless navigation. But to achieve this level of functionality, we'll work closely with the communications staff, leveraging their expertise. So as I review the components of the governance manual, I will also highlight several items relevant to your responsibilities as board members. Now, these concepts are not new. These are part of our regular board meetings, but today's overview simply brings together the activities that you routinely perform and illustrates how the manual consolidates this information in one place. The document begins with foundational information. It provides an overview of SDRS as a statewide defined benefit plan for public employees that offers retirement, disability, and survivor benefits, and plays a critical role for participating employers and members across the state. Another essential component of the mission of the project is the mission statement, vision, and long-term goals adopted by the board. They really are at the core of everything that you do. On the screen, you'll see the mission statement. It's to responsibly manage a financially sustainable system with fixed resources and prepare our members for retirement. The vision is to be a model retirement system that is fully funded, delivers benefits that meet our long-term benefit goals, and provides members the foundation to achieve financial security during retirement. There's also a more condensed version of the long-term benefit goals. As indicated, we will have a long discussion about the long-term benefit goals document in June, but there's also a concise statement that you'll see in this section with the mission statement and vision, much like you would see on our website or in other printed publications. Another key component of the manual is the governance structure. SDRS is created and governed by state law, which defines the board's authority, the funding requirements, and benefit structure. The manual outlines each of these provisions related to governance and provides context for each of these. And I'm going to highlight just a few of these statutory provisions today. The board, of course, oversees SDRS and is responsible for setting policy, monitoring funding, and directing the system's long-term strategy. We're going to discuss the board's oversight responsibilities in more detail when we address fiduciary duties. The board conducts its official business at quarterly meetings with additional meetings as needed. A majority of the trustees constitutes a quorum, and board actions require 8 votes and a majority of those present. The board's decision-making process is collaborative and grounded in actuarial, legal, and financial analysis. The board consists of 17 members, 14 elected representatives from specific membership groups, 2 gubernatorial appointees, and 1 non-voting ex officio member representing the South Dakota Investment Council. The structure ensures balanced representation, defined terms of service, promote continuity and experience, and the election process ensures fairness and member participation in governance. For efficiency, the board has established committees, and the manual will include those authorizing letters or charters for each of those. And the board elects a chair and a vice chair annually at its September meeting. One final point on the governance structure itself is that the board appoints an executive director to manage the daily operations of SDRS, and then the statute goes on to authorize the executive director to hire staff as needed to support the system's functions. A key section of the project really concerns the board responsibilities. The most important responsibilities of the board is to act as fiduciaries. The 3 core duties are loyalty, prudence, and following the plan document. So you've received some fiduciary presentations in the past. I'm not going to go into great detail, but I'm just going to highlight some of the key points related to each of these duties. Loyalty requires acting solely in the best interest of all members and beneficiaries of the system. A fiduciary must prioritize the interest of the system as a whole, set aside any personal or appointing group interests, and of course, avoid conflicts of interest and self-dealing. The duty of prudence requires fiduciaries to perform their responsibilities with the care, skill, prudence, and diligence that a knowledgeable person familiar with the matter would exercise. This duty includes selecting and monitoring plan service providers. Now, to support this obligation, the board has implemented a comprehensive process of independent verification and confirmation, which is outlined in the manual as well. The duty of prudence also encompasses thorough preparation for and participation in board meetings. While fiduciaries may rely on expert advice, they must take reasonable steps to verify the information provided. The duty to follow plan documents requires fiduciaries to administer the system in accordance with the governing statutes and rules. And so fiduciaries must have a clear understanding of those provisions and assure that the plan is managed accordingly. This duty also includes reviewing and updating statutes and rules as needed and correcting any errors. These responsibilities align closely with the legislative processes undertaken by the board at its September and December meetings, and I will discuss the legislative process separately later in this presentation. So statutory law also assigns specific responsibilities to the board for managing the system and the trust fund. These are outlined in the manual along with the applicable reference. For example, the board establishes the effective rate of interest for each fiscal year, which you will do later today. Also today, you will establish the interest rate for the supplemental pension benefit contracts. That's also required by statute. Another example is that the board establishes the cost of living adjustment using the methodology established in statute. Another statutory responsibility is that the board must adopt actuarial assumptions and make them public. Also of note is at the beginning of each legislative session, the board must deliver an annual report to the governor and legislature on the system's funded status. These, I guess, are just some of the requirements in statutory law, which is our plan document. In addition to our plan-specific requirements, the board must comply with broader legal obligations, including open meeting and public records laws. Another section of the manual concerns approvals that the board completes. The board oversees key actions and documents that ensure the system is well managed, efficient, and aligned with its goals. So the board will routinely approve the minutes of each board meeting, engagement of professional service providers, the annual administrative budget for SDRS, any proposed legislation to be recommended for introduction during the legislative session, the election results for board members, policy issues related to SDRS benefit determinations, and any board position papers or statements relating to goals and objectives. In addition, the board receives formal reports on the system's key financial and actuarial findings annually. The board will approve and accept these reports based on the determination that they fully disclose the system's financial and actuarial condition. Also, the board will approve and accept reports presented by professional service providers selected by the board. For example, you receive a report from Nationwide Retirement Solutions regarding the supplemental retirement plan and special pay plan, and you receive a report from CEM Benchmarking on the cost and quality of administrative services. If a group applies for Class B membership, the board determines that the criteria for Class B membership, Class B public safety membership has been met. And finally, there are annual reviews that related to SDRS personnel. The board annually reviews the performance of the executive director, as outlined in the executive director compensation and performance appraisal policy. And the executive director annually provides a report about staffing and succession planning. Another section of this project relates to financial transparency. The board has both statutory and fiduciary responsibilities to communicate SDRS's financial status clearly and transparently to all stakeholders. To fulfill this obligation, SDRS staff, under the board's direction, published several annual reports. They're listed there on the slide: the ACFR, the Annual Comprehensive Financial Report, the Valuation Report, the Funded Status, to name a few. In addition to that, the Investment Council presents an update on investment results at each board meeting, and the Senior Actuary provides a projected funded status report offering a current estimate of year-end funded status and the corresponding COLA range for the upcoming July 1. These reports are further supported throughout the year by presentations to the Retirement Laws Committee, the Joint Appropriations Committee, the Executive Board of the Legislative Research Council, and other stakeholders, ensuring that policymakers receive timely and accurate information on the system's funded status. As I alluded to earlier, a key feature of this project will be to provide easy access to the board's planning and policy documents. The board has set clear goals and objectives to help guide how SDRS is managed and how success is measured. These goals are designed to ensure members receive solid, dependable benefits while also maintaining strong funding standards and sound management practices. There are two primary policy statements that I'm going to highlight. First is the funding and system management document. Since SDRS is managed with fixed contribution levels set in statute, this statement establishes minimum funding objectives and criteria for recommending changes when these objectives are not achieved. It also outlines conditions for considering benefit improvement recommendations. The second document is the long-term benefit goals, which will be discussed in detail in June, and that will be your opportunity to confirm or revise these goals. The board has published other policy statements to summarize its planning process and policy decisions. The South Dakota Perspective outlines the board's positions relating to benefits, governance, and funding. A system guide to planning for the unexpected reflects a thorough planning process that identifies and prioritizes actions and activities and presents recommendations to be considered in response to changing economic conditions. That was just discussed by Travis as something that is up for discussion and regularly reviewed. There are also documents that will be included for their historical value. They remind us of where we were at a given point in time and why and how those decisions were made. Historical highlights provides a detailed history of changes and issues facing SDRS since consolidation. A benefit design for a new generation discusses the new plan design and how those choices were made. We also have documents that were written at milestones for SDRS, one for the 40th and one for the 50th year anniversaries of consolidation that will be included. Another section of this project covers professional conduct. I'll begin with the conference attendance because that's a topic you're going to address later at this meeting. As board members, professional development is important to maintain an informed and effective governance structure, and conferences allow board members to stay current on pension industry trends and issues. The board has adopted a conference attendance policy, and the goal of the policy is to ensure that attendance is purposeful, pre-approved, and aligned with the board's mission. Now, there are some other policies that the board may wish to consider to guide your operations. We plan to work with the chair to provide some for discussion in June. These may include policies regarding meeting expectations, communicating with stakeholders, officer elections, among others. We also will likely bring some revisions to current policies for your consideration. And these policies really are beneficial because they protect both the system and the individual board members by clearly defining expectations. Now, any person acting in any capacity for SDRS is subject to the conflict of interest policy and the code of conduct adopted by the board. The conflict of interest policy is based on statute and other policies and the same policies adopted throughout state government. There are provisions specifically for both employees and board members. Now, when the code of conduct, while the code of conduct, applies to all individuals acting on behalf of SDRS, most of its provisions are actually orientated towards staff. So the board may consider at some point to adopt a code of conduct tailored more specifically to board members. One piece of the code of conduct that I'm going to highlight applies specifically to board members and SDRS employees, and that's the gift policy. The gift policy states that if you receive something of value more than something worth more than $25, because of your role with SDRS, you must report it, unless it's something everyone receives at a meeting or conference. Another section has to do with legislative activities, which I referred to earlier when we discussed following the plan documents. This section really covers the process and guidelines regarding the board's interaction during the legislative session, particularly with legislation. The board has always been committed to advancing strong and responsible pension policy. And as part of that role, the board may recommend legislation that enhances plan administration, ensures compliance with federal requirements, and provides clarity and flexibility. Our legislative package for this past session is really an example of achieving these goals. The board may also recommend updates to statutory plan provisions. If minimum funding conditions are not met, the board must make corrective actions. Likewise, when statutory conditions for benefit improvements are satisfied, the board will make recommendations regarding those changes. All proposed changes must, of course, have the approval of the legislature and the governor. To support this process, the legislature established the Retirement Laws Committee, which provides the structured, informed review of proposed pension legislation and plays a key role in maintaining consistent, well-reasoned pension policy. Now, when the board submits proposed legislation, it also provides the committee with a clear explanation of why the change is being recommended, along with an actuarial impact analysis prepared by the senior actuary, so that both the policy impacts and the costs are fully understood. If someone has proposed changes to SDRS, the board encourages them to present their ideas to the board, explain the need for the change, and address any questions. This process ensures the board fully understands the intent, evaluates the implications, and makes an informed decision. So the board will oppose any proposal that does not allow for this careful and thorough review. Before I wrap up, I just need to note that your responsibilities as board members extend beyond the defined benefit plan. You also oversee 2 complementary savings programs, the Supplemental Retirement Plan, or SRP, and the South Dakota Special Pay Retirement Program, or SPP. A section of the project highlights these programs briefly. The SRP, of course, allows participants to defer compensation and invest in options selected by the state investment officer. Then account balances, including earnings, are available after employment ends or in some other limited situations. The board also serves as fiduciary for the SPP, which is a tax-deferred retirement plan funded by an employee's special pay, also known as termination pay. Termination pay is that unused annual and sick leave. Contributions are excluded from gross wages, and both contributions and earnings are taxed only when withdrawn. And as discussed earlier, you receive an annual report from Nationwide on these programs. So, to sum up, think of the governance manual as your single comprehensive source for your duties and responsibilities. It consolidates statutory requirements, pairs them with some explanations and examples, and the goal is to create this comprehensive source for both the board and the staff. In June, we'll review some additional policies for you to consider. And then our goal again is to have a completed manual ready for your consideration in September. However, as I mentioned earlier, this document is intended to evolve. It's a living resource that will require ongoing updates as laws, policies, and practices change.
Good. Are there questions? We discussed this the other day. I can't believe we didn't have one of these before. It seems like
It's long overdue.
long overdue.
And, Paul will recognize that and we're gonna get it done.
Used to be when we had more paper, we used to have books that had like their goals and different things and stuff in them, which had some of this. This is a little more comprehensive. But like I said, I think it's long overdue also. I don't know if that covered what everybody had any questions. I mean, we'll be bringing this up the next meeting again, but it gives you a good overview of what's going to be included.
Yeah, today I just wanted to share with you the things that the board routinely does, has already adopted. Next month or next meeting, we'll look at some newer issues and then need some board action at that point.
And I guess if somebody thinks of something that, it should be in there, maybe an email to Jackie would,
Absolutely.
if somebody thinks
Yes.
it's always open to suggestions there.
Absolutely.
Otherwise, if nobody has any questions, I think we would like about a 10-minute break here.
How about us come back at 10:30?
7 minutes.
7 minutes? Okay, we'll come back at 10:30. All right, it's 10:30 and we will come back to order. And next item on the agenda is the legislative report. And John is going to handle us along with some help, I think, but I don't know if you had to.
I'll let John go ahead and start and I'll back clean up here.
Mr. Chair, members of the board, my name is John Richter. I serve as General Counsel for the SDRS, and I'm joined by Sam Koldenhoven, who is Deputy General Counsel. And just wanted to begin by thanking everyone for the opportunity to provide a brief summary of this year's legislative session. During the 2026 legislative session, SDRS introduced 6 bills, and I'm pleased to share that all 6 passed unanimously. Before highlighting any of our bills, I just wanted to make an observation. And what stood out to me again this year is just how fortunate we are to have the structure we do. As Jackie Storm referenced in her presentation, the SDRS board is made up of 17 members, each bringing a unique background and perspective. This structure really allows us to examine any proposal thoroughly and from every angle. And most importantly, through the lens of what's in the best interest in the members and beneficiaries. This year, we also benefit from members of the Joint Retirement Laws Committee joining us in December for a substantive discussion ahead of session. So for those who contributed, we thank you. Our bills wouldn't be what they were without your perspective, your engagement, and your input. Now, in relation to the bills themselves, I think we can generally say 5 of the 6 were in the administrative sphere. So just general cleanups, which our members appreciate because whenever we bring those cleanups, they allow them to understand the code and navigate things more efficiently and more effectively. The bill that has garnered some interest, and I'm happy to say, and I think we had spent a bit of time at previous board meetings discussing, it was Senate Bill 54, which reduced or provided an in-service distribution at 59.5. I've been approached a couple times by members already wondering, when does Senate Bill 54 go into effect? So I think we were able to accomplish something and provide something that is in the interest of the members and the beneficiaries, and they're very happy about. So I wanted to convey that to the board. So with that, in relation to the other bills, everybody receives my weekly updates throughout session. We looked at a lot of bills. We tried to figure out what would be of interest to the board. There's just a lot of legislation that goes through one way or the other. Just from a statistics standpoint, the number of bills that were actually brought was higher than normal, but the number of bills that passed overall was right on par. In terms of bills that directly affect the board itself here, we have some administrative stuff on our side in relation to open meetings, how things are noticed, how we make descriptions, but there's nothing in particular that would require action from the board at this time. So if there's any questions about what occurred during session, I'm happy to address those. And if there's no questions, I just thank the board for their engagement. I'd also like to thank the Joint Retirement Laws who joined us in December and contributed to the discussion. In particular, Representative Wisegram and Senator Dybert offered suggestions about how to break up our bill package and whether to present them individually or all together. And we decided to go 6 separate bills, which added to efficiency. And, I'll tell you, when we were presenting our bills, we were able to present them, and it was very mechanical. So I think it ran very efficiently thanks to their contributions as well. So thanks again to all who played a role, and we look forward to another successful legislative session next year.
I think James Apple had a question. So want to state your question?
Yeah, I would just like to say thanks for sending the weekly updates out. You started that last year, and this year it's just so good to follow along, see where we are versus getting it all at once. So again, that weekly update for your team, sending that out to all of us, it really keeps us in the loop and know where everything's at. So again, I just wanted to say thank you to your team, and you guys did a great job. But I really appreciate the Friday updates, because again, that's something to go through and read and get through and just see where we are with everything. So thanks again.
And I guess the one thing I would say in relation to the weekly updates, yeah, it's my name on the email, but the weekly updates do get vetted throughout the SDRS staff. And, you know, Travis looks at them, Jackie, Sam, Jamie, Dawn. So there are a lot of eyes that look over those weekly updates. So it's definitely, although it may come from my email, it's definitely a team effort, and it's something that we're happy to provide. And, you know, going forward, if anybody sees any information that they'd like to have, anything spelled out differently or presented in a different fashion that could benefit the board, we're happy to consider it and happy to implement it, just to make sure it continues to be engaging and meet your needs.
Any other questions? You know, I something that I thought about, and there's been some interest in this allowable earlier withdrawals from the SRP. Are we going to track how much of that's done? Be kind of interesting to know if there's a mass exodus, which I don't expect.
Yeah, our intent is to track this. You know, we've talked to June and her team about the importance of having this information. I suspect that we have quarterly meetings with SRP, so I suspect it'll be in that report as well as the annual report to you as a board. Matter of fact, I'll make sure that happens so we can keep track of that as well, because I am curious to see how this all plays out and the utilization of that. So definitely plan to track it.
Mm-hmm. Good.
I think from there, I'll just maybe make a few comments and regarding the budget. You know, it was a great process again this year with the appropriators. You know, it's always fun to sit in front of the appropriators and tell our story and have those conversations. Eric joined me this year for the budget hearing again. And we also had some other staff members that got to speak a little bit with the appropriators as well. There was questions centered around some of the external audit component and that sort of thing. So Michelle Michelson was able to jump in, and then one of the chairs, Chair Representative Derby, met with Doug and I the evening before at a social event, and he promised that he was going to come back for our budget hearing and ask an actuarial question, and he did. And it was very good. And so everybody got to get engaged a little bit, which was awfully nice. Again, they asked great questions, as they always do during the budget hearing, and then just a lot of compliments on the management of this plan, which is directed towards all of you as Board of Trustees. They just were very impressed with everything. I think one of them referred to us as kind of the shining star, or however they said that. They're very proud of the system, and we just need to continue to be boots on the ground. But they did approve, most importantly, they did approve our budget, the board approved budget. And so that did pass through as well. But they just continue to show the support and confidence in us, which, you know, I always tell everybody we don't take for granted, because when you talk to your colleagues and peers across the country, they don't have the same experience that we do here in South Dakota when it comes to the whole legislative process. And we're very, very lucky that we do get that support and confidence. And we don't take that for granted at all. You know, I would also like to do a shout out to the Retirement Laws Committee members as well. Specifically Senator Dybert and Representative Weisgraham as the chairs. Very easy to work with, you know, when you're coordinating those bill hearings and those sort of things. But all of our Retirement Laws Committee members are just fantastic. Again, very good questions that they always ask. They're always interested in our bills, want to take a deeper dive. And I do think it was beneficial that they joined us in December prior to session, just getting an understanding of where we were going, also giving us some really good feedback on how we could take that approach, as John stated. So it just makes the overall process even better when you can have a good team like that. And so again, it was a great session. We're going to continue to be boots on the ground, continue to cultivate those relationships. That's our job, is to be there to answer and guide them, answer their questions and guide them. And we're going to continue to do that. And so, and hopefully the sessions will continue to be positive, because we want to continue to be transparent and answer those questions. So with that, I don't think I missed anything, but it was just a great session overall.
It's actually really fun to go to the budget hearing and over to the legislature because we have such a great story to tell. It isn't always fun to go to a hearing at the legislature, but in our case, it is because we have a great story, we have a great reputation. It's just fun to go over there and just tell about all the great things that we're doing here. And so I always enjoy that time that we can go over there and talk to appropriations, talk to the retirement laws committees. Yeah, it was a good session. And it's a good, that's just credit to the staff and to the whole organization as to be able to make it a fun experience because we're doing things right. All right, any other comments about legislative stuff? If not, let's move on to setting the effective interest rate for fiscal year 2027. And I think I'll turn that over to you.
Yeah, unfortunately, you guys get the B team on this one. Michelle Michelson's under the weather. And so I'm going to tackle setting the effective rate of interest for fiscal year 2027. You should have been provided a copy of the domestic interest rate statistics for calendar year 2025 as published by the Federal Reserve Board. The U.S. Treasury bill secondary market average on 3-month issues is the average 91-day U.S. Treasury bill we use in the calculation required by 312C 108. The Treasury bill rate for calendar year 2025 was 4.07%. South Dakota Codified Law 312C 108 requires the rate shall be no greater than 90% of the average 91-day U.S. Treasury bill rate, which calculates out to be 3.663%. It is important to remember that this interest rate will start accruing to member accounts July 1st, 2026, but isn't payable to their accounts until June 30, 2027. The interest rate that has been accruing and will be posted to member accounts as of June 30, 2026, and was approved at the April board meeting was 4.473%. So, Mr. Chair, at this time, we need to seek approval for the setting of the effective rate of interest to be credited from July 1st, 2026 to June 30, 2027 at 3.663%. And that was a mouthful, but we do need a motion for that. Thank you.
All right, I would look for a motion for that. All right, Hank?
Prim moves to establish the fiscal year 2027 effective rate of interest payable June 30th of 2027 at 3.663%.
All right, I have a motion from Hank Prim. Who's
Second.
I have James Apple seconding that.
Oh, there we go.
Is there any discussion? All right, hearing none. All those in favor, please indicate by saying aye.
Aye.
Aye. Aye.
All right, those opposed, please indicate by saying aye also. All right, hearing none, that motion is carried. Let's move on to item number 12, which you're going to take that one too.
I'll take that one as well, yes. Again, that time of year to set the fiscal year 2027 supplemental pension benefit interest rate assumption. We do that on an annual basis. The board establishes that interest rate assumption upon which those the subsequent supplemental pension contracts will be based. After review of the appropriate annuity rates and fixed income instruments available in the marketplace, the external actuary has recommended an SPB interest rate assumption of between 4.25% and 5.25%, and the state investment officer has recommended an interest rate assumption of between 3.25% and 3.75%. So based on this information and a process that we've used in the past, where we actually land was right in between those two recommendations. The staff is recommending the use of a 4% interest rate for fiscal year 2027. So we would need a motion to establish that supplemental pension benefit interest rate assumption for fiscal year 2027 at 4%.
Right, I would look for a motion.
Bruce?
Cruz, can you read the motion?
Be great.
Let's see. Do you have a motion that you can read in, or somebody have a motion they can read in? to the record?
I move to establish the 2027 interest rate assumption for the supplemental pension benefit at 4%. Oakland.
All right, I
Bruce
have a
will
motion.
second that.
All right, I have a motion from Jake Oakland and a second from Legina Cruz. Any discussion on that motion? Seeing none. Those in favor say aye.
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 Anybody opposed, please indicate by saying nay. Hearing no opposition, that motion is carried. Item number 13 is board member conference approval, and there's 5 people. Maybe I'll let you go through those.
Yeah, I can take this one as well. You know, as board members, you guys have heard me say this before, and you get, you know, our policy and the calendar for conferences, but as board members, you do have the ability to attend a conference each year. We do have the expenditure authority for that. Really, at the end of the day, you know, that continuing education for you as a board is a part of your fiduciary responsibility as well. We try to do our best in bringing in as much education as we can. Matter of fact, here a few years ago, we started bringing in multiple, you know, a speaker or maybe even multiple speakers to our September meeting, just to try to bring some of that education to you, because I know all of you have your day job as well. And those day jobs may just not provide you the opportunity to get away and attend one of these conferences. You know, I always find these conferences to be extremely valuable, not only because of the great presentations that you see, but it's the relationships that we build. We get a lot of networking out of this, where we can learn from our colleagues and peers across the country, and we're not afraid to share our experiences with our friends across the country, nor are they worried about sharing their experiences with us. I think we prefer that, actually, because we all want to see each other be successful at the end of the day. But anyway, we did have 5 requests for conference attendance, and part of the policy states that the board has to make approval for these requests. We did have 5. However, we do have 1 that we're going to remove from the request list, and that's Hank Prim for the IFEBP Trustees Institute. Hank now has a conflict and is unable to attend, and so we're going to move that number to 4. So we've got Shane Roth. Has requested to go to the NASRA annual conference in August. He'll be attending that conference with Doug Fiddler and myself. And then Jill Leonards, Eric Stroder, and Lori Grunland have requested to attend the NCTR annual conference in October, and they'll be joining me, which I'm really excited about, because a few years ago, I was always there by myself. And then Eric finally decided to join me, and now I've got a couple of other board members joining as well. It's a very board-heavy attended conference. And so, you know, all my friends and colleagues across the country always introduced me to all those board members, and I felt kind of lonely as I was the only one from South Dakota. So excited to have some board members join me in that. So, Mr. Chair, we would need a motion to approve these requests. I think for efficiency, we could take them all with the one motion if they would just indicate the name and the conference that they'd be attending.
Okay. Is there a motion to approve those? I think I have a motion from Hank here.
I move to approve Shane Roth's attendance at the NASRA annual conference, Jill Leonard's attendance at the NCTR annual conference, Eric Stroder's attendance at the NCTR annual conference, and Lori Grunland's attendance at the NCTR annual conference.
Do I have a second to that motion?
Second, Johnson.
All right, Myron Johnson seconds that motion. Any discussion? I didn't think we'd have too much. All those in favor indicate by saying aye.
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 If there are those opposed, please say nay. Hearing no opposition, I'll declare that motion passed. Item number 15 are the reports from the Executive Director Evaluation and Compensation Committee.
We've got 14 yet. We've got all
Oh,
the business.
I'm looking at the wrong sheet here. That's why.
Yep.
Let me go back to that. Where's my other sheet? There it is. All right, we got old and new business. That's right. That's why I'm on the wrong feed.
And I can move through this quickly as well. Under old new business, we've got our board SharePoint portal page. Really here, it's just, getting your feedback on this is important. As Jackie alluded to earlier, the governance manual will be an electronic document for you. It'll be housed within the board's portal page for easy access. And of course, it'll have those quick links to a lot of the policies and position papers and other documents for you guys. So we're really trying to create a central repository of all of those things for you to be successful as board members, kind of that one-stop shop, if you will. And so we're building this for you, and your feedback is always critical on this. Not suggesting that you have to give any here today unless you'd really like to, but you could certainly send myself an email or Nick an email or even Jamie. We would like that feedback because again, we're building it for you guys. We want to know what you like, what you don't like, if we're missing anything. Of course, we're still adding things to this and we're still building on it, but we really do encourage your feedback. And so if you wouldn't mind sharing that with us, we would greatly appreciate it. Second on the old new business is the upcoming meeting dates. You'll see those down at the bottom of the agenda. We only have through 2026 at this point, the end of 2026. I promise you that I will have 2027 out there for the June meeting, so you guys can start planning ahead. Hard to believe we're saying 2027. It's just kind of crazy thinking that far ahead. With that, I really don't have any other old new business other than maybe if I could just say add one. You guys all saw the email, and there will be a celebration of life for Paul Schrader on June 8th, and just letting you guys know that's right before our board meeting. But I know I'm planning on flying to be at that, and I know that not all of you'd be able to attend that did know Paul, but I will be representing you as a board and SDRS. Paul was a significant family member for us, so I just wanted to let you guys know that as well.
All right, thank you. That's all the old new business, I assume. And that brings us to the reports from the Executive Director Evaluation Committee and the Compensation Committee, which generally we would go into executive session. And maybe explain, we got to have a breakout room for a Zoom meeting on that.
Well, probably the last thing you want to do is have a non-techie person try to explain the techie side of this, but I'll give it a stab here. So what we're going to do, just because I know you guys are going to want to go to executive session, we did create a breakout room for this so we can keep the public broadcasting on the original meeting side. You don't have to do anything as the attendees, I don't believe. I think what's going to happen is Jamie is just going to send you right over to that room where you guys can have that privacy to discuss that, but we will need that motion to go to executive session. And then once you guys conclude there, they'll come out and grab a staffer and we can get you guys back to the main room so we can finish up the discussion on my evaluation as well as adjourn the meeting. So we're going to guide you there, but we do need that motion for executive session first.
Okay. That explains things. I would look for a motion to go into executive session for this.
PRIM moves to go into executive session pursuant to SDCL 125 to sub 1 to discuss items relating to personnel matters with potential staff who may be invited to remain, including Travis Almond.
Second to that motion?
I'll second again.
Oh, Vice Chair seconded that? Okay. Assuming there's no discussion on that, we will take a vote. All those in favor say aye.
Aye.
Anybody opposed, please say nay. Hearing no opposition, we will declare that motion passed and go into executive session.
Just give everybody just a minute here. They'll start transferring you to that room. I don't.
Yeah, text me if you don't make it there. Or text somebody here.
Three dots. Don't see it. Yep.
Double check.
Oh, I'm a. Here they come.
Here they come. Yeah, what is it? Probably.
And you'll have to turn the mute off.
Be good.
Okay,
So.
okay, and everybody can hear me, I think. So we're coming out of executive session. We had the executive director evaluation and the compensation committee report. Basically, out of the session, I'd like to thank you for all that you do. Really very good evaluation. A lot of discussion about, you know, how they really helped the system and done a great job. So I don't know if you have any other comments really that we have for the public forum, but thank everybody that served on the committee and everybody on the board that contributed to the discussion. So leaving that item, the only thing on my agenda is to adjourn, I think, unless you had something else.
The only thing I would say is, based on the comments that you guys said during executive session, to me, it was nice compliments in that. But as you guys know me, I'm not going to take those. I'm going to pass them along to where they really belong. And when you go behind that secure side of the building where all the staff work, that's where the compliments go. Because without those folks, SDRS is an SDRS.
Yep. All right. Is there anybody who would like to make a motion to adjourn?
Shane Roth, make a motion to adjourn.
All right, I have a motion from Shane. Is there a second?
Second by Johnson.
All right, a second by Myron Johnson. All right, all those in favor of adjourning, say aye.
Aye.
Anybody that's opposed, please say nay. Hearing none, that motion is carried. We are adjourned.
Have a good break, everyone.
Have a good Easter.
Happy Easter.